Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed with an hour left in the trading day. We're still looking at losses here across the board. The Dow, though, just barely negative, not too far from that flat line, off just about 33 points. S&P off about 1/3%. Nasdaq, the biggest decliner of the three major averages, off just about 0.6%. In terms of the sector action, a bit of a mixed picture. Consumer staples and healthcare, the outperformers of the day, but the biggest declines coming from communication services, consumer discretionary, and technology, Dave.
Kind of a meh. Let's get you up to speed now on China, rolling back some COVID isolation policies and dropping test requirements for some public places. People now with mild and asymptomatic cases will be allowed to isolate at home for the first time. The moves appear to be in reaction to those mass protests that swept across the country in recent weeks, which in some extreme cases even called for President Xi Jinping to resign. Shauna?
Speaking of President Xi Jinping, we want to take a look at oil because oil's off just about 2.5% today, and that move coming as President Xi Jinping visits Saudi Arabia, now the world's top oil importer and oil exporter, sitting down amid tensions between the two countries and the U.S. Right now, China is Saudi Arabia's biggest buyer of oil, also its top trading partner. This trip coming amid a significant week for the oil markets, for the energy markets, what we've been talking about here, Yahoo Finance. And that includes a new price cap and also EU sanctions on Russian oil.
Continue to move down. For more on the broader markets, we turn to Great Hill Capital Chairman and Managing Member Tom Hayes in studio with us again. Good to see you, my friend.
Great to
Let's
be back.
touch all those topics and go in reverse order and start with oil, which continues to move down despite the price cap and the EU sanctions, reflecting what?
Well, I think, one thing that no one's really talking about these days is the U.S. rig count. And the U.S. rig count is at 784 total rig count. Pre-pandemic, it was at 790. So while everyone's been focused on Russia and they've been focused on production abroad from OPEC, they've kind of failed to focus on the production in the U.S. has come back, and it's come back in spades. So I do think that that supply is going to continue to come online, and we're seeing it reflected in prices.
And Tom, just more broadly speaking, where we stand right now in the equity markets with the final trading weeks of the year ahead of us, the fifth down day in a row for the S&P. How does this set us up not only for the next couple of weeks, but as we look ahead to next year?
Well, there's a buyer strike. It's a low volume buyer strike right now, but there will be no Grinch. I think Santa Claus is going to come to town the last couple of weeks, but we're in a holding pattern waiting for the data. So we got the strong jobs report. Market didn't like that. We got the strong ISM services. The market didn't like that. But as we look forward to PPI on Friday and CPI on Tuesday, just before the Fed meeting, I think those numbers are going to come in better than expected, meaning lower than expected. And you need only look at the 10-year yield. I mean, it's telling us that there's a slowdown. It's telling us that the Fed is near the end of their job. I mean, today, the 10-year yield was down to 343. And that's just telling us that it's a disinflationary environment moving forward. And in disinflationary environments, you want to start to look at the things that people have left for dead, communication services, tech, et cetera, and emerging markets with the dollar starting to weaken.
So you suspect that the sleigh that brings Santa will be the CPI data we get next week?
Yeah, I think it's going to be the PPI. I think it's going to be the CPI. The key is going to be the dot plot, though. That's what I think is the biggest concern. The terminal rate at the last meeting in September was 4.6%. That's probably going to tick a little higher, hopefully 4.8, 4.9, nothing over 5 that would spook the market. And in that case, Santa will have a sleigh full of presents for sure.
And Tom, speaking of spooking the market, lots of debate about whether or not we're going to be if we are already in a recession, if we're going to see a recession next year. Citi CEO Jane Fraser was making some comments about that, expecting a recession next year. Where do you stand on this? Any difference from last time?
Yeah, well, if you look at the last 6 cycles since 1957, there's a lot of pessimism in the market. Everyone's saying earnings are going to come down another 10 or 20% because we're going to have a recession. But in each instance since 1957, the stock market bottomed 6 to 12 months before earnings bottom. So if you buy all the pessimism that earnings are going to come down another 10%, you shouldn't be buying a new leg lower. You should be buying stocks, because history shows us by the time earnings trough, the S&P 500 has made up most of the losses. Why is that? We know the market is a discounting mechanism. So this year we discounted a lot of slowdown with a 33% peak to trough in the Nasdaq, 25% peak to trough in the S&P. This is not a time to buy wholesale to buy the S&P, but it is the time to buy selected opportunity, and there's a ton of it out there.
Okay, what is it? What stocks, what sectors?
Well, what do people want the least of right now? I would say tech. And if you look at the 10-year yield, that's telling us a slowdown, and what companies can actually generate earnings in a slowdown is historically tech. Amazon is trading at 2018 prices. The difference between now and 2018 is their ad business and their Amazon Web Service cloud business have both tripled in those 4 years. The e-commerce business has doubled. Their Prime members have gone from 100 million to 163 million, and you can buy it at 4-year-ago prices. So that's kind of interesting to us. The other thing, what's everyone been hot on this year has been energy. Well, if you look to next year's estimates for earnings, the worst performing sector in terms of earnings growth is going to be energy with negative double digits, negative 10 or 11%. The best performing sector in terms of earnings, which no one wants to touch with a 10-foot pole, is communication services, and that's going to grow 35%. And consumer discretionary is going to grow, which also no one wants to touch with a 10-foot pole. They're growing off of low bases, and that's what we like.
So, Tom, when you're trying to identify some of those communication services names, also consumer discretionary, does it become more of a stock pickers type of market? Because there clearly are some winners or losers when you drill down into those two sectors.
Unquestionably. You know, Warren Buffett says if you wait for the robins to sing, it's already spring. While everyone was sucking their thumbs waiting for China to invade Taiwan, he was in buying $4 billion of Taiwan semiconductors. So, you know, we like, you know, whether it's Amazon down 55%, Disney's down 55%, that's an absolute no-brainer when you look 3 years out. Taiwan semiconductors down. K-Web, the China Internet ETF, down 70%. There are only so many times in a lifetime or in a generation that you get an opportunity. The tech wreck was one when tech was down 80%. The K-Web was down peak to trough more than 80%. And then you go back to the Great Depression, buying the Dow Jones down 80% in 1932. These are generational opportunities. The government has come out, they've pivoted on the COVID zero policy, and they just came out in the last 24 hours and said, we're going to do forceful monetary and fiscal stimulus in 2023. No one believes them because we haven't seen it in the last 24 months. But when they say forceful historically, that's meaningful. And they don't have the inflation pressures that we have because they've been buying all the oil from Russia. They've got tons of storage of oil. They've got no inflationary pressure, so they can stimulate till the cows come home.
And no one is buying that China reopening because we've been sold this line a dozen times over the last couple of years. You are, though, this time. Why is it different?
Well, I'll tell you what, I mean, you talk about Amazon, you can buy at 4-year-ago prices. You can buy Alibaba at its IPO prices from 2014. The only difference is revenues are up 800% and earnings and cash flow are up 500%. This is a generational sale, and this is what the market does. It's a manic depressive. It's bipolar on the upside, it's bipolar on the downside, and it's overshot. It got down to 58.
Talking about me?
I'm talking about Mr. Market, as Ben Graham taught us and Warren Buffett has reiterated for many years. These are the opportunities that life serves up. And you have to seize them when they're there, because if you look at the growth trajectory of Alibaba, their digitization, their Ali Cloud business is where AWS was in 2016. So this is going to be a monster opportunity. If you look at all the reports, they've got 38% share of the cloud business. It's going to triple by 2025, and we think that's a great opportunity.
And Tom, real quick before we let you go here, what's your outlook when it comes to the jobs markets and the layoffs that we have seen? Started in tech, we started to see that kind of trickle out, kind of had a ripple effect throughout other industries. Something to be worried about, or more so the correction that, not so much that the Fed predicted, but I think many on the street have been bracing for?
Yeah, I think the contradiction in 2023, in our view, is that the stock market is going to get better and the economy is going to get a little bit worse because we've discounted a lot of the pain. So I think the Fed will be successful in terms of they said they wanted unemployment to go up a little bit. I think we will see a 4 handle on that, maybe mid-4s max. It really depends how quickly they stop. We know we've got 50 in the bag in December. Question is February. There's a lot of data points between now and February. It could be 25 and done. I know that's not in the market. It's more like 50 and then maybe another 25. But we'll see. 2 months of data points is an awful lot. And if that 10-year is right, I think we're going to see some disinflationary data, as we saw with the Manheim used car index today.
I'll tell you, it was Debbie Downer Day yesterday from the bank CEOs.
A lot of optimism, though, today. Great way to start the show.
We really appreciate that. All right, Tom, good to have you in. Great Hill Capital, always a pleasure having you in studio.
Thanks for
having me. All right, just getting started here on Yahoo Finance Live. Coming up, shares of Carvana. Free fall after a Wedbush analyst says the used car retailer's risk of bankruptcy is rising. He joins us to explain. Also, national security concerns are reportedly holding up negotiations between TikTok and the U.S. government. We'll give you the latest. And meme stock favorite GameStop reports earnings after the close. We'll bring you the numbers and analysis as soon as they drop. Stay tuned.
Let's take a look at Carvana because shares off 39% right now. It's the top trending ticker on Yahoo Finance. The stock has been halted multiple times today. Wedbush downgraded Carvana as its largest creditors signed a pact to act together in negotiations. Now, Wedbush now has an underperform rating on the stock and a dollar price target. Earlier today, I spoke to Seth Bashan, the senior analyst at Wedbush, behind that note, asked him about the downgrade and also the risk of bankruptcy. Let's take a listen to what he had to say.
The bottom line is that bondholders are getting together to put up a united front in negotiating with the company, likely over a restructuring of all the outstanding debt. And from an equity holder standpoint, we see that as a growing risk, potentially for dilution if the bondholders exchange any debt for equity, or in a more dire case scenario in bankruptcy. So we see the equity as being out of favor, and therefore we downgraded our stock rating to underperform.
Seth, when investors are trying to make the timeline of this, the potential scenarios in their head, when you see the timeline for a potential default bankruptcy, are we talking months? Are we talking a year out? What does that more specifically look like?
Well, in a normal course of action, based on our liquidity analysis, we see the company having enough liquidity to survive through 2023. And in fact, they have a lot of real estate that they could monetize to help extend that timeline. However, a lot of different moving pieces here could accelerate that depending on what happens to the market and depending on what happens with some of the terms of the agreements with the bondholders. So we're not looking at that as a top probability right now, but we do think we'll see some sort of restructuring, some sort of capital structure change in the coming months.
Seth, you mentioned the real estate holdings there, about $2 billion that was noted in your note. Would the best alternative then to be at this point to raise capital to sell off some of those real estate holdings?
Yes, that's been our stated view for some time. We think that's the best way for them to get extra cash, extend their liquidity timeline, and potentially pave the way for an equity raise. But right now, that's only one of the alternatives that the company is pursuing.
Seth, when you take a look at Carvana, try to make sense of what has happened over the past year and a half, because last August, the stock was at $377 a share. Today, obviously off just around 98% year to date alone. Is this more of a Carvana specific issue when it comes to what has played out over the last several months, or can some of this be attributed to rising rates and the slowing that we've seen in the overall economy?
Yeah, it's a combination of both, certainly. The used car industry is under a lot of pressure right now. Demand has fallen off a cliff. Used car prices went up dramatically through the pandemic. Interest rates went up. Affordability for the consumer went way down. So now we're seeing a big decline in demand. You couple that with Carvana's specific problems, especially an acquisition they made earlier this year, which was ill-timed and added a ton of interest expense burden to their income statement. That is a more company-specific problem that's leading to some of these situations today.
And that's the massive $2 billion, I believe, acquisition that they made of ADESA's U.S. auction business. When you take a look at some of the missteps that have happened, comparing that to what we have seen from some of the other competitors in this space, how does Carvana more specifically add up to maybe a name like AutoNation, which has fared much, much better so far this year?
Yeah, if we look at some of the other franchised auto dealers or other used auto dealers like CarMax, we definitely seen them fare better. The used auto dealers are seeing more pressure. However, somebody like AutoNation is doing better because the new car business is not under as much pressure, and they have a huge revenue base from their service business. That helps them offset some of the pressure in used cars.
When you take a look at Carvana, where it's trading today, it's been halted a couple of times. What's the best case scenario then over the next couple of months?
Best case scenario is that the equity gets very little dilution here, and there's no bankruptcy situation. The company infuses more capital, either through a real estate sale or otherwise. And we see a debt exchange, which leads to less debt burden going forward. So that would be the best case. I will point out that the Garcias, who are the CEO and his father, they own over 40% of the company's equity. And so they have a very big incentive not to let that equity go to zero.
Our thanks to Seth Basham, Wedbush senior analyst. Dave, Seth was just talking about the Garcias there having a personal incentive not to let Carvana fall to zero. But this chart has just been incredible, and for all the wrong reasons, something that investors clearly do not want to see. We're looking at year-to-date losses of over 98%. This stock at the high was much, much higher than it is today, up above $300 a share. Taking a look at where it is today, Wedbush saying it could go to $1. So did Morgan Stanley's Adam Jonas. Lots of concern about what exactly is ahead and whether or not bankruptcy, it seems like it is likely to be in the cards.
It's almost like the best thing that was said about them in recent days was JP Morgan. The possibility of imminent Chapter 11 seems low. That's the best thing that's been said about Carvana in recent days, because, okay, they can survive through 2023. They have enough cash to get through the next year. That appears to be the upside. But what is the catalyst for positive movement, for any sort of comeback? No one has one. No analysts that we read. And you talk about pandemic darlings, right? You talk about Zoom, you talk about Peloton, you might talk about Netflix. To me, when I close my eyes, that vending machine on your screen right there is the picture of a COVID darling business failure. I'm not talking about the sector, but that right there, a $41 billion market cap, now less than 800 million.
It's just been incredible to watch. And we've seen Carvana clearly be a massive underperformer within this space. Many of its competitors have performed well, or have performed at least better. We just heard Seth talking about that. But the sector overall has taken a huge hit. And I think everyone's trying to figure out what exactly this means for used cars going forward. We certainly have seen the prices of used cars come down. But newer selling cars, that has held up some of its competitors. The fact that that has been a little bit more resilient over the last several months. But I think there's a lot of unknown, because a lot of these names, like you were saying, were really bought up into the pandemic, had really taken off, had scaled a little bit too quickly, way too quickly in Carvana's case. And we're seeing, obviously, the effects of that today.
But those other three companies I mentioned, there's a lot of catalysts to potential
Totally
skyrocketing in the
different
future where there
scenarios.
isn't one here, and it was a perfect storm. Everything that propelled them has now completely flipped and done a 180.
They scaled way, way too quickly. All right, well, coming up next here on Yahoo Finance Live, investors growing increasingly concerned about Tether. We will tell you how the crypto contagion is impacting this stablecoin, and we'll tell you why a new tipping system at Starbucks has customers outraged. We've got the details for you. Stay tuned. Coinbase shares today trading lower, off just about 1.5%. CEO Brian Armstrong telling Bloomberg in an interview that the cryptocurrency exchange's revenue is set to be cut by half or more this year. The crypto industry has been battered by falling prices and, of course, the fallout from the FTX bankruptcy. So far this year, Coinbase shares have dropped over 80%.
All right, today our Jennifer Schonberger interviewed SEC Chairman Gary Gensler about the crypto collapse. Here's what he had to say.
There's about 10,000 of these crypto tokens. And then there's not just dozens, but maybe hundreds of service providers, broker dealers. They might call themselves exchanges. I might call themselves other things. You might think of them as the casinos, wherein the investing public is looking for a better future. And because most of these tokens are securities, that means that the storefronts, if you wish, or the casinos need to come into compliance with our time-tested laws.
More from that interview later in the show, but in the weeks following the FTX collapse, the question is turned to when, not if, the next domino falls and whom it might be. How widespread will the damage be? Is there any longer such thing as an actual stable coin? Well, Liz Hoffman is a writer at Semaphore.com. She's been reporting on this story. Liz, good to see you. How stable is the stablecoin Tether?
So far, it's mostly held up. And we should explain a stablecoin. The idea is that it's tied to something. Its price is pegged to something else. Most of them are pegged to the US dollar, but there's some that are pegged to euros or gold. And the idea is that you give them your money, they give you a stable coin, and when you want it back, you can get it back at exactly that $1 peg. So these things should trade kind of like money market funds, right at $1. And if they start to quote unquote break the buck, that's when things get dicey. Tether has dipped under it a couple of times. It's regained its ground for the most part since the FTX collapse. But the real concern about Tether is the assets that it holds. But what did it do with customers' money once it got it, and how liquid is that cash? Could they get it back if they needed it? And everything is seizing up across the crypto ecosystem.
Yeah, and Liz, that's a big question. I know you dug deep into this just in terms of what this could potentially mean, how big of a risk this does mean, or this could be for investors. So what did you find?
So Tether, the last sort of a disclosure they made was in September, and they had about $69 billion of assets, the vast majority, 82% of which was in things that look pretty liquid, things like treasuries, cash, some reverse repurchase agreements, but things that, if they are what they say they are, should mostly be fine. The problem is that when you get redemptions, you have to sell the stuff that you can sell. And so over time, the less liquid parts of the balance sheet, what you're looking at there, the other investments, which appear to be mostly equity stakes in crypto startups, secured loans, again, they're lending against tokens. That stuff is much harder to sell. And so, if there's a lack of confidence and you start to see real reserves come out of that company, people wanting their money back, they're going to have to sell the stuff they can sell, which means the stuff they can't starts to make up a larger percent of what they own.
And to that point, investors have pulled $4 billion out since late October. Why, and what's been the impact?
Well, in part, everyone's just freaked out, right? This was the FTX collapse is just a real existential moment for confidence in the crypto ecosystem. The other thing, though, is that there's a couple of reasons you might want to own Tether. Certainly, if you're just bearish on crypto and you like the space, but it's also sort of a token that you can use within crypto ecosystems. You get some trading benefits. It's a pretty easy way to move around. You might think about it if you go to a video arcade and get a bunch of tokens. They're helpful to have. There's just a lot less of that happening right now, right? A lot of people have just been totally scared out of the crypto business or sitting on their hands. So there's not a whole lot of utility. There's not a real reason to own Tether if you're not doing a lot of crypto trading, and you're not getting really compensated for the risk of whatever else is on their balance sheet. Whereas you can put your money in treasuries and get 4% these days. So it's really a push and a pull that people really got scared and driven out. But also, if you're not playing in the arcade, there's not a lot of reason to own a bunch of tokens.
Well, Liz, let's do a scenario here. What if it fails? Talk to us just about the ripple effect, how concerning that would then be for the entire crypto industry.
Tether is hugely popular. If you think about it like a stock, it's got a market cap of, in the $60 billion range. Obviously not quite as big as some others like Bitcoin and Ether, but it's big and it's held in a lot of places, and it is the collateral for a lot of loans. It's a thread that if you start to tug on it could unravel very quickly. I should say outflows have stabilized in the last couple of days. They have said very publicly that they are perfectly solvent, perfectly liquid, that they will be fine. But I think if you look at FTX, and I want to be a little careful because there's some underlying behavior at FTX that's problematic. When confidence comes out of these systems, it comes out all at once, and you end up with what looks, to most lay people like a run on the bank, and it just happens incredibly fast.
Liz, when you take a look, I guess if people are interested in crypto, don't really know where to put their money, a little bit spooked about everything that's played out within that industry over the last several months. From your reporting, I guess, where would you identify the safest places to be at this point?
I try very hard not to give financial advice, particularly in crypto. Look, Bitcoin has held its value better. I mean, we all remember a time a year ago, and it was 50, 60,000. It's now around 16. And it was, I think, a little over 20 before FTX went under. But that seems to be, people have more or less gotten their head around that there will be some more or less permanent value there. So that's held up pretty well. Ether has held somewhere between 1,000 and 1,500 for a while. So those seem to be the winners in all of this. But as we've seen, the stuff can just change so quickly.
Certainly can. And I have been very, very amazed that Bitcoin has held up pretty well, just under 17,000 today. Liz Hoffman, thanks so much for joining us.
Thanks for having me.
Dave?
Shauna, tis the season for Starbucks peppermint mochas, provided you did not invest in an S&P index fund to start the year, because they will set you back north of $7 with tax. Of course, your caffeine intake is not the only thing going up from there. You see, Starbucks has rolled out a new tipping feature, and for those who pay only with credit cards, and baristas are, well, steamed, if you will, and customers are angry, venting frustration on TikTok are these baristas with the new hashtag barista problems. You see, videos are racking up millions of views, employees even hiding from their customers when this awkward transaction ensues. They hold out the credit machine. Option one, $1 tip. Option two, $2 tip. Or there's the option to do none or other. Here in New York, your average Starbucks barista makes $16.75 an hour. Not bad. Here's a tip then for Howard Schultz. Make those options a quarter, 50 cents, and call me a cheapskate. 0 should be on the main screen for pouring my cold brew in a cup. And Shauna, my tipping point came last night. Madison Square Garden this guy here paid $17.24 for a hard iced tea. $17.24, and then came the option for the tips. $1, $2, $3. You know I chose other and opted for a quarter. Am I a cheapskate? Or if we all just reached our collective tipping point, it is absurd.
It is a little absurd. I also like that your choice was twisted tea out of everything that was available at MSG, but we'll talk about that another time. But no, a quarter, I do agree with that, because I think a lot of people are a little bit overwhelmed, and I think people feel bad about if they don't tip and they want to give something, but they don't necessarily want to give $1 or $2, especially in this current economic environment when people are paying more and more for almost every single product in their life. So I think it was interesting what you said about the baristas, some of them hiding and it being
They're
very
embarrassed by
them.
this policy.
Yeah, so I wouldn't be then surprised if maybe Starbucks shifts its whole view on this maybe they should take your advice, offer a quarter or 50 cents. But more broadly speaking, tipping this holiday season, the trends that we are seeing, more people are tipping, but to your point, they're tipping less. So if you are maybe giving more of an option, the quarter, 50 cents, something that doesn't jump out so much to the people that are buying these products on the screen, it will make everyone feel a little bit better, and people will take home more at the end of the day, hopefully.
Yeah, look, and I think you're actually hurting these baristas with this policy, not just the embarrassment factor, but the fact that I'm staring at a $1 option after a $7 cup of coffee means I'm ultimately more likely to push 0, because there ain't no way we can afford an $8 cup of coffee. So I think the smart policy would be to bring it, when we used to have some change in our pocket, that's what we put in the tip jar. Do you or do you not? I admit, sorry baristas, I do not tip at Starbucks.
But you tip. I've seen you tip. You've tipped our barista here.
Our guy, yes. I do tip our guy at the coffee bar.
You don't have to count yourself out. I don't always tip. Sometimes I do, sometimes I don't. Really depends on the mood. But I would tip a lot more if there was a quarter or 50-cent option. I do agree with you.
Let us know how you feel about this on Twitter if you would. Coming up, Apple adding new security features for iMessage and iCloud. We'll tell you about them next.
Time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We have Southwest, GM, and Apple. Press Supermedian is also here with us to break down some of these biggest movers. Let's kick it off with my pick, and that is Southwest. The stock moving to the downside today, off nearly 5%. Citi warning of higher capex in the fourth quarter, noting that the potential issue of pilot pay, that could be an issue here coming forward for these airlines. This update from Citi coming as Southwest holds its investor day, where it kept its 2023 and fourth quarter outlook largely unchanged. It did reinstate its dividend at 18 cents a share. That dividend had been suspended during the pandemic pause. Lots of uncertainty around these airlines, what exactly demand is going to look like going forward after we get past this kind of pent up COVID demand. People will pay anything to travel right now. Prices are still very, very high. Questions about whether or not people are going to still be willing to pay those prices in a couple of months from now.
You know, I saw that Thanksgiving air travel has returned to pre-pandemic levels. Lots of people traveling. That leisure travel is back. Business travel coming on soon. It's funny you mentioned that they're reinstating that dividend. They have that while the pilots are picketing over new higher wages. So you have that kind of dichotomy of companies saying, hey, we want to reinstate the dividend, but they ordered a bunch of new Boeing planes that are going to actually eat into costs too. So that's another thing to watch there for Southwest. Sticking with transportation, I'm watching GM here. The company's dealer community charging program just started. GM's working with local dealers to install 40,000 level 2 chargers across the country, targeting rural and underserved communities. These chargers aren't located at dealerships themselves, but areas where the dealer, working with local authorities, determines what's the most useful spot for these 40,000 chargers. That would double the amount of level 2 chargers in the country right now. And the automaker has earmarked $750 million for that program right now.
And it's interesting now, just to go into that, what you mean by level 2. From what I understand, that means it takes hours to charge an EV all the way up, as opposed to the top level, which can charge it in 30 minutes. So I'm thinking to myself, where do you put these if someone has a couple of hours to then charge their EV?
They're talking about
How significant is that?
Because DC chargers, those fast ones, are really expensive. So the next level below it, level 2, put them at a coffee shop, a library, a government building, and people have business to do there, park the car, charge it there. A bit more better access for local people.
Would be much more helpful if they were, of course, the more expensive variety, get a lot of more people charged. And then Tesla can use them with the converter, I believe, right?
Yep.
Okay, interesting stuff. All right, my play is Apple. Shares moving down today on Morgan Stanley cutting iPhone shipment estimates by another 3 million units, accounting for that slower China production. Analysts had previously cut 6 million shipments in November, which brings the current forecast down nearly 10 million to around 75.5 million. The holiday season typically makes this Apple's biggest quarter. Morgan Stanley estimates, though, a 3% hit to revenue because of all this. Meanwhile, another development for Apple in the positive, planning to significantly expand its data encryption practices as it expands iPhone privacy protection. And it is an optional system, and they do call it advanced data protection. You can opt into that. Shares of Apple down about 2% on the day, down 22% year to date. It's been a rough go given all those China lockdowns.
It certainly has been. Apple clearly very much affected by the China lockdowns, affected by the recent protests at their Foxconn plant. When we also put this into dollar terms, I know Morgan Stanley was estimating 3 to 4% hit in revenue. Dan Ives saying that it's costing Apple $1 billion a week in lost iPhone sales when you take into account all the protests, the stoppage there at a very, very important plant. This could be a rough couple of months ahead for Apple. We know the holiday season is so critical, so much emphasis on iPhone sales in particular during the November and December months. So a huge step back here is pretty worrisome here to a lot of these shareholders.
Yeah, these China sort of reopening is sort of happening there, but at the same time, we're seeing closures in other areas. We've seen that in auto roll with Volkswagen, for instance, shut down a plant, even though we're seeing people sort of opening up other cities. So for Apple, it's a big, big deal.
Tesla's had some issues there as well.
They certainly have. Certainly supply chain issues alive, unfortunately, overseas. All right, well, coming up next, our next guest telling us about ETFs that help you profit from the Fed's interest rate hikes. We've got the details for you. Stay tuned. We're closing in on the end of the fourth quarter, and with interest rates on the rise, we're going to take a look at some of the ways that you can hedge that trend. We want to bring in Cynthia Murphy, ETF Think Tank Director of Research, joining us now in this week's ETF report brought to you by Invesco QQQ. Cynthia, it's great to see you. So some investors have been able to counter higher rates with a specific hedge. What are you seeing in terms of inflows in some of those popular investment opportunities right now?
Hey, Shauna. Yes, it's been really cool to see. There's two ETFs specifically that stand out on that, hedging interest rate effort, and they're both relatively new. They're barely a year old. So these are tools that have come up in the market as providers try to figure out ways that they can help investors mitigate interest rate risk. And, we've seen, given that they're a year old, they're still not really that big, but they've gathered up more than $450 million this year. And so the way they're combating that interest rate risk and hedging that fixed income sleeve of your portfolio is, one is the ticker is PFIX, and it does that through a mix of options and treasuries that result in you basically having a portfolio that behaves like you have a put option on a treasury bill. So you're kind of shorting treasuries, essentially. There's convexity in there. There's a lot of, bells and whistles, but the strategy essentially behaves like you're shorting treasuries, and it's up 85% this year. So it's one of the best performing things out there this year because interest rates have gone up, as you know. The other one is also really interesting, and the ticker is RISR, Riser. And that one achieves the same kind of effect through a negative duration portfolio, which is, then when you have a negative duration portfolio in fixed income, that's when your prices will go up when rates rise. And so that portfolio is up about 30% this year. It's shelling out 8% yield. So these are new tools to the market that have been really successful in actually delivering what they're designed to do, which is, hedging that interest rate risk in your fixed income sleeve.
And you're also seeing, Cynthia, strong demand for small cap value ETFs, which points to what?
It's been really interesting because, you would think you do not want small caps in the market environment we've had. And we've just started noticing, like in the last month, a lot of money start to flow into small caps and specifically value. And, reading flows, it's trying to, assert what investor sentiment is. It's a little bit like reading tea leaves, is like what we like to say. But you could argue that it could suggest that either the concern about recession is already priced in, either investors are more bullish about what's ahead than bearish, because in our post-recessionary environment, small caps tend to outperform large caps. They're also currently at their cheapest valuation relative to large caps in something like 20 years. So in the last month alone, more than 80% of all small cap ETFs picked up assets. In the small cap value, that's even stronger because value is the factor that's working relative to growth. So it's been kind of interesting to see and trying to interpret, does that mean that people are a little bit less concerned about recession? Does that mean that they're already positioning for a rebound in which small caps will probably lead? So it makes it for like an exciting story to follow.
Speaking of an exciting story, I guess, Cynthia, just more broadly speaking, not only U.S. small cap ETFs, but the ETF industry in general, there is this risk of recession. We know there certainly has been a significant amount of inflows into ETFs. U.S. ETFs seeing more than $60 billion in inflows in the month of November alone. How does this set us up, though, as we look ahead to next year with that risk of recession?
Yeah, so far this year, ETFs have picked up about $560 billion, which is a big number. It doesn't compare to what they picked up last year, but it's a strong number, and it suggests that investors are staying invested. I mean, just yesterday, Dimensional put out a study that shows, you miss 1 week in the market because you're trying to time your stay, and your gains go down 20% if you pick the wrong week. And there's all sorts of studies out there and statistics that show, the moment you try to get out and then get back in, chances are you're going to get it wrong and you're going to leave a lot of returns on the table. So the ETF flows suggest that people are moving money around. They are trying to find alternatives to that fixed income. They're trying to hedge things like interest rate with new tools. So it's not that just people are parked in the market. They're trying to be tactical to prepare for a recession or, a prolonged bear market, but they're staying invested, and product launches are coming. We have more than 400 new ETFs in the market this year. So innovation is still going. So I think it's a sign of a healthy market. I think it's a sign of investors trying to stay the course and find ways to survive this route. And hopefully some of the studies coming out saying we may be bottoming by mid next year are right, but I guess we'll see next year.
Yes, we will. We will take it for now. Cynthia Murphy, great to have you. Appreciate that. A national security deal between popular social media app TikTok and the Biden administration is at a standstill. The Wall Street Journal reporting that security concerns are holding up negotiations. We spoke with Senator Mark Warner recently, who has been really speaking out about security risks he feels the app poses. Here's what he told us.
If at the end of the day, the Communist Party and President Xi can dial up or dial down the content that your kids may be seeing, that would worry me.
Does indeed. Yahoo Finance tech reporter Ali Garfinkel here with more on this. Ali, nice to see you. How is TikTok responding to all of this?
Great to see you, Dave. So, from TikTok's end, what they're saying is that they're in a holding pattern right now. These concerns, this stalling, it's not the first time we've seen these talks stall. And in this case, it is for national security concerns, right? The government is worried that they can't necessarily trust TikTok to agree to the terms of the deal. They can complete it fully. They're also worried about how the company uses data in its recommendations algorithm. Now, for TikTok's part, right, what are they saying? They're essentially saying the government hasn't come back with new demands as to how they might go about addressing some of those security concerns. So from TikTok's end, what essentially they've said actually is that they're waiting for an update. There is some stuff we do know, Dave. We do know that Oracle has stepped in to kind of agree to be TikTok's American babysitter, if you will. They've agreed to help TikTok move U.S. user data to servers in Virginia, not in Virginia, I'm sorry, Oracle servers, but they are moving from data centers in Singapore and Virginia. So, Oracle's kind of overseeing it. We'll see what happens. My expectation is the talks will probably begin again relatively soon. It should be said, TikTok has 1 billion users, Dave. It is ubiquitous. I had an analyst say to me earlier this week, you cannot overcover TikTok. You cannot overstate how important it is right now.
It certainly is extremely important. Millions and millions of people are on it. Like you said, FCC Commissioner Brendan Carr was on our program last month telling us that anything other than a ban would not be sufficient. What's the likelihood, do you think, of an outright ban on TikTok? Because at this point, I would argue it doesn't seem that likely.
I would agree with you, Shauna, frankly. I've talked to a lot of analysts, and I have not found a single one who has said to me that they think it is likely that TikTok will be banned. It's also worth noting President Donald Trump back in 2020 tried to ban the app and failed. So there is precedent for there being an attempted ban and a failure, and any Wall Street analyst I can talk to thinks that there will be some kind of agreement reached eventually. It's worth saying, though, if that were to happen completely theoretically, Meta and Snap would really stand to benefit, who are seen as, who TikTok has kind of flagged as their base competitors and vice versa. So I don't personally think it's likely. Most Wall Street analysts don't. But you're hearing a lot of rhetoric coming out of Washington that's pretty fiery.
Indeed you are. It is far from done. Ali Garfinkel, thanks so much. Good to see you. Coming up, the three major indexes trading slightly lower ahead of the close. Find out which stocks are making the biggest moves when we come back. All right, some big moves on the board with just a couple of minutes to go in the trading hour. Let's get to Jared Blickery with what is moving and, of course, why, my friend. Good to see you.
Good to see everybody here. We got an earnings story today. Tech underperforming, and it's here that we begin our journey with MongoDB. You can see it's up 22% for the day, and here's a one-year chart. This is after beating on third quarter earnings and delivering a fourth quarter revenue outlook that was, quote, much better than expected. That's according to JMC Securities, which likes the company's strong leadership team, attractive market opportunity, and impressive growth at scale. Now, JMP is upgrading the stock to outperform with a price target of 215. And sticking with software, we're going to have to switch gears here for a little bit and go to our meme stock board. But I'm talking about GameStop. And here we go. GameStop is down about 5%. It's reporting after the bell today, but not before the stock likely posts its lowest close in 6 months. Street is looking for net sales of $1.29 billion on an adjusted loss per share of 29 cents. Take that with a grain of salt. Only 2 firms cover the stock. The computer game retailer just began a round of layoffs on Monday. That is according to Axios. And you can bet Yahoo Finance's Brian Sozzi going to be all over management tomorrow morning should they come out with that usual 8-minute earnings call later this evening. Now, also got to cover another stock. This is kind of a train wreck, and this is Carvana. We've been following this saga all year long, and this stock is down 43% today. And this, by the way, it started the day down 98%, and now it's down another 40% plus in the intervening hours. Vertigo alert, don't look down. The company is reportedly in talks with advisors, Kirkland & Ellis, as well as Moelis & Co., and this is on debt restructuring. Company's unsecured bonds are trading below 45 cents on the dollar. I could go on, but it's increasingly look like Carvana's ticker will soon be appended with a Q. Best of luck. Finally, we're going to take a look at a retailer here, and that is Academy Sports Outdoors. And let's see if we can find this on an equal weighted basis. There at the number 1 spot is ASO, and you can see this chart is over the last year. This rocketed to a record high today after lifting its earnings share forecast for the year. Bears are noting that the company cut its annual comparable sales target. However, Evercore rates the stock can outperform with a price target of $60 and is saying on the report, bottom line, gross margin is, quote, holding up better than anticipated, and it should be enough for the stock to hold on even with a comp sales deceleration. So there you go, guys. 4 tickers rounding out into the final minutes of the trading hour.
All right, Jared, thanks so much. And Ken Hicks, CEO of Academy Sports and Outdoors, chairman and CEO, is going to be joining Dave next hour, so you get to ask him all about it.
We will, man.
All right,
Good stuff, Jared.
Jared. All right, well, coming up
Really
here,
good.
we are counting down to the closing bell, about 3 months here until we get that bell. We'll be right back.
Jared was on fire.
He was.
Jared was
Brought
on
it.
fire. I like that hit. All right, just a couple of minutes away from the closing bell. Let's bring in Yahoo Finance's Inez Ferre to break down a lot of red on the board again, but not as bad as the last few days, Inez.
That's right, Dave. The Dow hitting the flat line right now. The Nasdaq down about 0.5%. The S&P 500, a fifth straight day of losses for that, but down about 0.1%. Here's the closing bell.
All right, well, that wraps up the trading day. Looks like the Dow is going to eke out gains just around the flat line, up less than a point. I guess we can call it a win after the last couple of days. S&P closing down about 0.2%. Nasdaq, once again, the underperformer, off just about 0.5%. We want to bring in Melissa Brown, Contigo Managing Director of Applied Research. We also have Ryan Payne, Payne Capital Management President and Pain Points of Wealth podcast host. Great to have you both here joining the show. Ryan, help us break down what we saw today, lack thereof, action, maybe more broadly speaking, if you take a look at the overall numbers, but the selling that we've seen recently, how that sets us up. What's your big takeaway?
Yeah, I think first off, we had a huge move in the market the last 2 months. So I think, bottom line is, and the Dow was up like 20% in 2 months. I'll take that for a year return. So we saw a huge rebound from the bottom there, and I think you're getting a little bit of profit taking in here. All of a sudden, every bank has gone very negative on the market at the same time. Investor sentiment has gone like kind of dire as well. So I would actually argue that's probably setting up for a pretty positive end of the year when sentiment gets that low. And the fact that, all year so far, the economic data has been pretty good.
It has been very negative, Melissa. In particular, as Ryan said, those bank CEOs, one after the other, forecasting some sort of recession early next year. Does this set us up for a positive end of the year?
Well, I hope so, although I'm not quite as confident as Ryan. I think we've seen very low trading volume. And so I think any news, we're going to see a bigger than expected reaction. So if the news continues to be good, then we could have a nice end of year rally. But if we start to get a little more negative news, maybe, the next bank coming out with a negative viewpoint, on that low trading volume, we could see a much bigger downturn than we might otherwise see if volume had been higher.
Ryan, the recent economic data points, it seems like at least is trending in the right direction. All signals point to inflation cooling just a bit. Jobs market, though, still remains relatively resilient. How do you square all this up in terms of what this likely means for Fed policy at the next couple of meetings?
Well, I think bottom line is the Fed has to be data dependent, which is an overused phrase. But if you look at it, oil prices, we're down to close to $70 a barrel now on oil, which is just a huge decline, which is that feeds into everything in the economy, right? So that's very disinflationary. Lumber costs down 60% now. Housing market at this point is starting to plummet. So I think the Fed has already pretty much set the stage to start to not only taper what they were doing before, but also stop raising rates here soon.
Melissa, what is ahead from the Fed, and what could be the catalyst to get things moving in the other direction? Is that CPI data next week?
Well, the CPI data will certainly be important, but, we've been looking at a year of, higher prints. It's going to take a long time for that year-over-year inflation number to actually come down, even if we see flat inflation on a month-over-month basis. And so I think it's something that the market, that investors are still going to be watching very closely to make sure we don't, I think they might overreact to even a slight uptick if the number comes out a little higher than expected. But, as Ryan was noting, with that decline in oil prices, that's probably, there's probably a lower chance of that happening.
Ryan, how does this set us up then for, just in terms of investment opportunity, where you're thinking about buying right now as we do head into the new year? Domestic versus international, what makes the most sense?
Yeah, well, I think international has already bottomed. If you look at China, they've had a huge bottom already. You're starting to see the dollar weaken, which as a U.S. investor, that's great when you're buying overseas. Valuations are cheap overseas. We've already factored in that we have an energy crisis. And if you look at, actually, hard to believe, but the FTSE 100, your UK stock market is actually positive for the year. Who would guess that? So I think global markets are recovering. I have money overseas as well here, and I probably wouldn't overweight tech the winners of the last 10 years probably won't be the winners of the next 10 years.
Melissa, just want to follow up on you mentioning that downward move in oil, given the price caps, given the EU sanctions, will it continue? And to follow up, you also say stocks are moving less on their own characteristics. What are they moving on, and what does that tell you?
Well, yeah. So when I say that, I mean that stocks have become more and more correlated with each other. So they tend to be moving in the same direction. And by the way, stocks and bonds have become more correlated as well, as have stock markets and the dollar. I think that suggests that investors are looking at the bigger inflation picture. Oil is going to impact, many, many different types of stocks. And they're looking at that more than saying stock A looks better than stock B, in terms of earnings. But, they've lowered their expectations for fourth quarter earnings. That we still have a while before we have to start worrying about that. But that is something also, I think that over the next month, we'll start seeing whether earnings are in fact coming in lower.
Ryan, take a look at small caps. Like you said, maybe the outperformance will come from what we haven't seen over the last 10 years. Small caps outperforming, 30% cheaper, I should say, than large caps right now. The biggest discount that we've seen since the dot-com bubble. When you're drilling down, trying to identify some of those names, what are you looking for?
I'm like a kid and candy store. If you look at valuations outside of tech, out of disruptive technology, everything right now trades relatively cheap based on history. And I think if you look at the macro picture, we know inflation's coming down. We know the job market's going to remain hot. Wages are going up. So I think the U.S. economy should be strong. I think small caps are a great way to play that. And I think overall, you don't have to be that smart here. Interest rates have gone up, so the bond market looks good as well. And I talked about this on my podcast, Pain Points of Wealth, one of the best financial podcasts in the country. So I think right now it's just you got to be in. Embrace the fact that we've uncertainty here. And I think everything's lining up right now for a pretty good rally across the board. Again, but just spread out your risk because the market's giving you a lot of gifts here in terms of buying.
And Melissa, what is the move in the yield telling you, particularly the 10 and the 2, and also the move in the dollar most recently?
Well, the 10 and the 2 inversion is the biggest it's been since 1981. Now, the good news in that is that starting in 1982, when the Fed started to lower rates, and I was around then, I hate to say it, we did see a multi-year rally. So it could be a little pain in the short term, but hopefully eventually, if we do end up with some kind of soft landing, that could be good news. But for right now, I think we do need to keep our eyes out for that soft landing because that is it's a very big inversion. And as Ryan also mentioned, the dollar is down well. I think that kind of volatility makes it difficult to negotiate. Where do you want to invest? Things keep changing so much. You might have positioned yourself for a higher dollar a month ago, and now you have to start selling. We haven't seen that yet, as I mentioned in the volume numbers, but we could start to see that as well. People need to reposition for a different economic environment than they had been positioned for.
All right, Melissa Brown, Ryan Payne, and thanks so much for joining us here this afternoon. Well, coming up next on Yahoo Finance, Senator Raphael Warnock's win in Georgia means that Democrats have a 51-49 Senate majority. We will tell you what it means for the Biden administration next. Shares of GameStop, they're actually trading to the upside, up just around 0.5% following their most recent quarterly results. Jared Blickery has a closer look at the numbers for us. Jared, I have to say I'm a little bit surprised that it's getting a little bit of a boost here in extended trading.
Yes, this is always a black box of a report as well. Not a lot of information here, but nevertheless, third quarter results, net sales coming in a little bit light, 1.19 billion. The estimate was for higher at 1.39 billion, and that's 8.5% lower than a year ago. That breaks down into hardware and accessories net sales of 627 million. That's down 6.4%. Software net sales, 352.1 million. That's down 19% year over year. And then collectibles net sales, 207.3 million. That's up 7.9% year over year. That was supposed to be a huge area of expansion for them. SG&A expenses, those came in ending the quarter at 387.9 million. Also, the third quarter proceeds from the sale of digital assets, those came out to $100 million. Inventory also coming in at 1.131 billion at the end of the period compared to 1.14 billion at the close of the prior year's third quarter. Not going to make too much of that right now. And then finally, another note here, sales attributable to new and expanded brand relationships were strong in the quarter. This is a company saying while sales in the collectibles category remain strong on a year-to-year basis. So that's all we have. We got a conference call at 5 p.m. As Brian Sozzi likes to point out, quarter after quarter, it rarely runs more than 10 minutes, and rarely do we have any executive on the call answering any questions. So we'll see what happens with this stock.
Not a strong investor. Yeah, exactly.
So you'll be taking close notes, is what you're saying.
I'm going to be eating dinner.
There you go. It doesn't sound like you're going to be missing much. We're going to be digging into these results with James Gellert, of Rapid Ratings chairman and CEO, is going to join us later this hour. All right, Jared, thanks so much for that. Well, with crypto industry in a state of turmoil, Yahoo Finance's Jennifer Schomburger sat down with SEC Chairman Gary Gensler earlier today to discuss the state of regulation in this space. Jen joining us now live. And Jen, what did you hear from him?
Good afternoon, Shauna. That's right. In an exclusive interview, I sat down with Securities and Exchange Chair Gary Gensler here at SEC headquarters in Washington to discuss regulating crypto and the aftermath of FTX's massive failure. Gensler suggested that FTX violated securities laws by using customer assets to trade at affiliated hedge fund Alameda Research.
Given that you've laid out that firms cannot use customer assets to trade with.
Our laws say this.
And,
Congress has said this. You can't use somebody's stock assets
But that's
either.
exactly what FTX was doing. So it sounds like they were in flagrant violation of SEC law.
I can't speak to any one case or any one situation, but our securities laws say that you need to properly segregate customer funds. You also shouldn't be running a broker-dealer or a hedge fund and an exchange. The New York Stock Exchange doesn't also have a hedge fund on the side and trade against their customers.
Despite the crypto meltdown, when it comes to regulating crypto, Gensler wouldn't say whether the agency would write new tailored rules next year, rather emphasizing that the agency would enforce the securities laws already in place. Gensler noted that the agency has taken 100 enforcement actions total against crypto firms, a couple dozen of which have come under Gensler's leadership. The chair told me he has one goal when it comes to regulating crypto next year, making crypto exchanges and lending platforms come into compliance.
They can do that appropriately, working with the SEC, or we can continue on the course with more enforcement actions. And I would have to say that the runway is getting shorter.
When asked why it's taking so long for crypto exchanges to register, Gensler told me it's really on the exchanges.
You've repeatedly called on these exchanges to come in and register. And you said you're talking
and not just register, come into compliance.
Right.
Separate out their businesses appropriately, protect the public.
But to your point, we've heard from Coinbase, the largest U.S. exchange, that they're in dialogue with you, but they say it's rhetoric now. They don't see a path forward. So given what you were saying, given what they're saying, what's the roadblock? What's the holdup here? Why is this taking so long?
It really is on these entrepreneurs and business leaders in the crypto space. And it's an area that has grown up worldwide with a lot of intermingling of customer funds on their platforms, providing interest returns to their customers, and then trading against their customers and the like. The basic protections in our securities laws for 80 or 90 years apply to this field as well. And so it's really on them. We've been clear. We can use some exemptive authority to tailor things, as you said earlier, but it's not to drop the basic protections of separating out these businesses into a separate exchange. And again, I remind the public, we don't let the New York Stock Exchange also run a hedge fund and trade against customers. Separate out a separate broker-dealer, separate out separate custody function, and really use the time-tested rules of the road that are on the books. So it's kind of up to them.
Gensler says some crypto platforms have asked the SEC to continue the ability to lend, trade, and operate an exchange and a hedge fund under one company, something the agency won't allow as is custom under traditional securities laws.
We said, no, you have to separate it out. Some have come in and said, can we have a lighter touch regulation? We've said, no.
Gensler says he thinks the agency has enough existing authority, that he doesn't need extra authority from Congress, though he says he would welcome more resources from lawmakers. Bottom line here, guys, looks like the SEC focused on using existing laws to enforce existing rules already on the books. No indication that there will be penning new tailored rules for crypto next year, something the industry has really been clamoring for greater clarity. Of course, that could spell more enforcement action, something that Gensler told me is a runway that is getting, quote, shorter. Back to you.
Hopefully he gets some help from Congress, which we're about to dive into now. Jen Schonberger, excellent stuff. Great interview. Thank you. We can officially squash the notion of any semblance of a red wave sweeping the country. Democrats have officially picked up one Senate seat with Raphael Warnock's win Tuesday night in Georgia. So now the math tips to blue states, 51-49. So what are the political and economic consequences? Joining us now to discuss is Ed Mills, Raymond James, Washington policy analyst. Good to see you, sir. Let's just give you a blank slate and start with the Senate. 51-49 is the new math. Biggest implications moving forward?
Biggest implications in the Senate is the confirmations. And with the confirmations that the Democrats will be able to have of anyone that Joe Biden sends up, two things happen. One, in committee, it's not 50-50 in committee, so you can easier get that to the floor. You'll actually have a majority in the committee. And then when it is in the floor, it's not that every single member of the Democratic caucus has a veto. That one vote kind of gap really allows President Biden to put up picks that will have an easier opportunity for confirmations. And the final thing on the committee issue is that Democrats can have subpoenas. They can do a lot more in the committee structure, especially with Democrats losing the House. Anything on oversight of Wall Street, oversight of big business, oversight of former President Trump, that will continue in the Senate, as it won't likely happen in the House with the Republican majority.
And that also, no one senator is going to have the veto power, which we so often saw over the last 2 years with Senator Manchin. When you take a look at what that means for the opportunity here, what this means for legislative policy going forward, how big of a factor do you see that being?
Yeah, Shauna, so I put kind of legislation into two buckets. Things that must pass, and that's things like the debt limit. We're going to have plenty of brinkmanship on that next year. Things like funding the government, not having a government shutdown. When I look at the House of Representatives, it is still a kind of trying to get to 218 is always the goal. The biggest change in the House of Representatives, besides the majority, is a shift away from proxy voting. Speaker Pelosi had it easier the last 3 years because if someone didn't physically show up, you could still count their vote if they had told you in advance how they wanted to vote. Republicans are not going to do that. The other bucket are things that could be bipartisan compromise. In that, it's cryptocurrencies. Is this going to be the crypto Congress? It's going to be a tough on China piece of legislation. Could you take some energy policy like Senator Manchin has been proposing as it relates to speeding up regulatory approval processes? So things from the middle are what could get done outside of those kind of must-pass bills that we discussed.
Yeah, the shiny object, pun very much intended, is crypto at the moment. Have to get something done there shortly. In the lame duck session, there was some optimism among cannabis companies that the Defense Authorization Act would include safe banking. McConnell took that out. Will anything get done in the lame duck?
Yeah, so the defense authorization is going to continue its post-World War II streak of the one bill that actually gets done every single year. We still have a continuing resolution on funding the government. That will absolutely occur, probably right up against Christmas Eve. In that, we're looking at some tax extenders that are really important to businesses about the expensing of research and development expenses. The cannabis banking, safe banking could get still added into that bill. We're looking at kind of a passage of an Electoral College Count Act in that, funding for Ukraine, funding for the hurricanes. So there's still a lot to get done between now and probably Christmas Eve here in DC.
And when you take a look at what just happened in the state of Georgia, Herschel Walker losing, Senator Warnock here being victorious in the state, what does this mean then for President Trump? Because President Trump was a huge backer of Walker. Does this essentially end his bid, do you think, for the presidential nomination in 2024?
You know, Shauna, it's way too early to kind of come to that conclusion. I certainly look at the midterm election results and, you know, you talk about that red wave that was expected. There was arguably a red wave in Florida. It just crashed up against that Florida-Georgia line. And so is that an opportunity for Governor Ron DeSantis to make a run at the nomination? We're going to see so many individuals who come out on the Republican side. For Joe Biden, does he seek re-election? If he doesn't, there's a whole long list, including probably Warnock, potentially on that list for Democrats. So I just kind of warn folks as it looks to the 2024 presidential election, immediately after the midterms, conventional wisdom is almost completely wrong as it relates to who will capture the nomination and who is likely to be the president. And I think that's probably going to be the case once again here.
Meeting with an anti-Semite, a conspiracy theorist, and suggesting we tear up the Constitution and undo the election. He's pretty much torching his chances and circling the drain, but we'll leave that aside for now. Over in the House, we're not sure if it's Kevin McCarthy's Republican Party or not, but this is a Republican House unlike anything we've ever seen. What is the direction there? Is it investigate Democrats? What do you think they hope to accomplish?
Yeah, so absolutely investigations are going to be a key part of the Republican majority in the House of Representatives. They would also like to have a conversation about kind of fiscal spending. Since the beginning of COVID, the United States has approved, Congress has approved $8 trillion more than we traditionally do. And so when we get to the debt limit, they want to have a conversation about kind of the fiscal path that we're on, especially entitlements, which make up at more than 60% of annual spending. I do kind of look at them and they want to replenish some of the money that has been spent on Ukraine to ensure that the U.S. defense capabilities are there. They're very focused on kind of anti-tech or kind of antitrust issues, big tech, tough on China. You merge those together. Is there going to be something like a ban on TikTok that comes out of Congress that gets put on Biden's desk? Those are the things that I'm watching from the House of Representatives.
There is some bipartisan agreement there, with in particular over in the Senate with Warner and Rubio agreeing on that package. Ed Mills, great to see you, sir. Appreciate you coming on. Up next, we're breaking down GameStop's third quarter earnings report. Stick around.
Let's take a look at GameStop. The stock now trading to the downside following its most recent results. Earnings and revenue both missing expectations. GameStop reporting a wider than expected loss. Net sales off 8.5% from a year ago. Software sales declining 19% year over year. For more on this, we want to bring in James Gellert, Rapid Ratings Chairman and CEO. James, it's great to see you again. So the stock kind of flipping back between positive negative territory here after hours. I guess your initial reaction from this report, because when you take a look at the misses, obviously doesn't set us up too well heading into 2023.
Yeah, Shauna, good to be with you again. And I agree. The fact that it was trading positive even for a minute or two was a bit surprising, and probably just says that some of the meme investors haven't completely been destroyed by crypto losses yet, because that's really the only supporting base that they've got. These numbers are disappointing. They are worse than estimates. I expect we'll continue to see a lot of pressure on the company for the balance of the year, but all through next year. Most importantly, though, these numbers don't change the narrative of this business. The underlying financial health of GameStop is weak, and it is not improving, and they have not been able to articulate a changed or a better business model than what they've been trying to do. And in fact, they're probably taking steps backwards.
Do layoffs change the fundamentals of this company? And if not, can anything?
Yeah, Dave, I don't know. Certainly the layoffs help in the sense that when you look at the cost base of the company, they're just spending too much money for what they're achieving from an operational perspective. So cutting costs has an opportunity to help them. But let's face it, the only real solid good story here is that they've got $900 million in cash, and that buys them a longer fuse life. At Rapid Ratings, we evaluate it by looking at the financial health, which is a one-year measure looking forward at default risk. And GameStop is rated at 39. In the last 20 years, 90%, more than 90% of companies that have failed have been rated 40 and below. So it's right in that zone. From a core health perspective, which gets to your question of the cost base, we look out 2 to 3 years to understand how efficiently the operations are run at a company and how well it's able to generate returns or be on the way to generating returns based on the assets and the capital employed that it has. And we have them rated as a 23. And these have been precipitously declining for quite a number of years. So from a core fundamental health and a financial health shorter term perspective, there's really not a lot good to say here about GameStop other than the fact that they've got enough cash to keep going for a while, for a couple of years, because they've got de minimis debt. If you don't have a lot of debt, it's not a lot to default on, but that doesn't mean you're building a good business.
Right.
Yeah, certainly a lot to be a little bit wary of. James, in terms of your channel checks, what you've been seeing so far this holiday season, when it does come to GameStop's actual business, any indication there just in terms of how this quarter is shaping up?
Doesn't appear to be all that good, but I think they're struggling with the same problems that they've been struggling with for a long time, which is not a lot of people are going into bricks and mortar stores to buy software. They're not buying discs. They can buy online, and the digital strategy for GameStop really hasn't worked very well. And in fact, they're leaning into crypto, and their alliance with FTX has been a complete failure for a lot of obvious reasons. But I think retail in general is struggling this quarter. It is going to continue to struggle. And if my 16-year-old's view is any indication, GameStop's got an awful lot of work to do, or he's not going back.
And as if you pointed out, the stock doesn't always trade on the fundamentals of the company, but let's talk about the broader decline in gaming. Do you expect that to continue into 23?
Well, 23 is going to be interesting because we will see a slightly better supply chain efficiency level than we saw in 22. Those who support GameStop say that some of the pent-up demand for buying software came from delayed orders of consoles. We're seeing slightly better throughput in supply chain, but a lot of challenges coming up along the way, not just from residual pandemic problems, but the geopolitical disruption, particularly in the Ukraine, but also all of the challenges in China are putting a tremendous amount of additional potential strain on supply chains. And then the last point is we've got a lot of small companies and private businesses that are upstream in supply chains that are under incredible financial pressure right now due to inflation and capital markets credit access problems that are coming down the pike. So I think all of those are going to ultimately create a continued difficulty for the software industry, but certainly for GameStop being at the very front end of the retail of that business.
And quickly, James, with the caveat that you will not, what could you hear in the call that might change your perspective on GameStop?
The strategy. They just need to be able to articulate some direction for the business that doesn't feel like a punt. And the crypto strategy was a punt and it didn't work. And they really have to be able to articulate how they are going to increase the efficiency and the core health of the business going forward, or people will just start to focus on how quickly that cash is burning down. And remember, the 1.1 billion they raised in the middle of 2021 was riding on the highs of the meme stock bubble, and they were able to bring in liquidity. If that hadn't happened, or if they needed that cash again today, I don't know that they'd be able to raise it.
All right, lots of questions here when it comes to GameStop. James Gellert, always great to have you. Thanks so much for breaking down that earnings report for us. All right, well, rising inflation and more frequent car accidents are pushing car insurance costs higher. That's according to a new report from Insurify. The average cost of car insurance rising 9% this year to $1,777 a year. Insurance rates rising the most this year in Oregon, Maryland, Virginia, and Idaho. And now insurance experts are estimating that costs are going to go even higher, up another 7% next year. That will push insurance payments to over $150 a month. Well, coming up, shares of Academy Sports and Outdoors are soaring after notching an earnings beat this morning. The company's CEO tells us why investors and consumers are excited about what's to come next.
Check out shares of Academy Sports and Outdoors. Up more than 15% on the day on today's earnings report, reaching a new all-time high. Investors apparently pleased by an adjusted earnings per share of $1.69, topping expectations of $1.59. Let's talk about that and what's next for Academy with the chairman and CEO Ken Hicks. Let's get a few sports cliches in here. A real softball, your chance to spike the football. How do you see the quarter, sir?
Started off the fourth quarter well. We had our biggest Black Friday in the history of the company, and we continue to make a lot of people happy as they go out and have fun with all the merchandise we sell.
Shares up now 28% year to date, a remarkable performance. What are you seeing, sir, in the consumer?
The consumer they are challenged, but they are looking for value, and one of our strengths is the value that we offer. They also are looking for things that they can have fun with, they can enjoy. In today's world, we all need a lot of fun, and that's what we sell. We are about experience, and our broad assortment of merchandise gives us the ability to really please a lot of customers. I think as far as the investors, what they see in us is our growth potential as we continue to develop the opportunity for further growth. We added 9 new stores this year, plan to add another 80 to 100 over the next 5 years. We are growing our .com, which was up double digit for the 5th straight quarter. And we've got a real strong base of existing stores in our markets.
We see the map on the screen of your current 268 stores. Will you be expanding into other regions?
Yes, we just this year opened a new store in Virginia and a new store in West Virginia, both of which are doing very well. So we are not only strengthening in our core market, but we're moving into new markets. And with the customer reaction in those, it gives us great encouragement to look to expand beyond our current footprint.
You mentioned Black Friday. What do you see in terms of e-commerce versus in-store?
Our e-commerce has been strong. It's been underdeveloped, but as I said, we've been up double digit. What we've really done is develop true omni-channel. Half of our e-commerce business is pick up in store. And so a lot of customers go online, but they decide to come in either because of the timeliness of getting the product, or it's a bulky product like a treadmill or a bicycle, and they want to come pick it up and not pay for the shipping.
Are you seeing inflation begin to ease?
No, not really. Inflation is real. It's out there, and it's causing us to really think through our pricing. We emphasize value. And so we want to make sure that we have a $59.99 children's bike. We have our folding chair that is iconic at $4.99. And we work very hard to offer those great values for our customer every day.
So you talk about a consumer that is cautious and inflation not easing. Do you see signs of a looming recession in your business?
There's the possibility of that. I think they're more concerned about inflation and what inflation does to them. That said, we actually had some of our best years in 2008 and 2009 because of the value component. People come to us and look to us as a source of getting great value for their dollar. And so we are not, I won't say we're happy about having tough financial times, but we are not as concerned as some other retailers might be, because we know how to make sure that we can weather through the tough times.
And you talked about how the consumer has stopped buying as many goods. They are buying experiences, which has helped business like yours. And one of those experiences people are looking for seems to be pickleball. Are you seeing that in the numbers? Is it something you can quantify?
Yes, pickleball last month actually outsold tennis. And we've got a very strong pickleball assortment across all of our markets. And We sell the rackets, the balls. We even sell the ability for a person to set up their own pickleball court in their driveway or, in a parking lot, so that they can play the game without having a real formal court.
Oh, let's do that here in the studio next time you're out here, Ken.
Well, we'll get you one, and we can play. And remember, pickleball favors the older participant.
You're saying you could kick my butt? Is that?
Well, it would be fun.
Let's mix it up. I can't wait for that. I'm going to hold you to that. Ken Hicks, CEO of Academy Sports and Outdoors. Congrats on an outstanding quarter. Coming up.
Thank you very much.
Good to see you. Taylor Swift fans are not the only ones upset over her concert ticket debacle. Find out what Congress wants to do about it. Next. Live Nation can't escape the heat of the Taylor Swift ticketing fiasco. Now the House Committee on Energy and Commerce is calling the CEO, Michael Rapino, to the Hill to explain exactly what happened. Yahoo Finance's Alexandra Canal has been all over this story for us. Allie, this new development, clearly Congress wants answers.
Yes, they do. And quoting our executive producer from earlier, this is just one story that won't go away. It will not die. Now Congress is adamant for those answers. In a letter addressed to Michael Rapino, the committee requested the process that this company has taken when it comes to the Eras Tour and what it plans to do moving forward to make sure that consumers have better access to live events. They also asked Rapino to schedule a briefing no later than December 15th. So the clock is ticking on this. The Justice Department reportedly launched an antitrust investigation. And remember, Ticketmaster and Live Nation, they merged in 2010. And since then, there have been repeated calls to break up this company. One of the staunchest critics in this has been Senator Richard Blumenthal. He was on our program on Friday. Here's a little bit more of what he had to say.
The artists, the consumers, the venues all have an interest in choices. They should have choices rather than one seller and being at the mercy of one seller, Ticketmaster, or any other single monopolist.
So the focus here is really on anti-competitive behavior. And if that's something that Congress can prove, that could potentially lead to a breakup. It could be a slam dunk antitrust case. And when we think about the stock reaction, it's down about 40% year to date. But shares of Live Nation did hit their lowest level since February 2021 in the immediate wake of this. So certainly not a good PR move for this company at all. We'll see, though, if it leads to any tangible change next year.
So often with these stories, and with all due respect, Congress gets distracted by a shiny object until the next shiny object comes along. But Blumenthal has a lot of pressure from consumers who want change, and he wants to pursue that breakup with the DOJ. In other entertainment news, early reactions in from critics on Avatar 2. I can't wait to see this film. The first one of the best-selling movies of all time. What are we hearing?
You're not alone in this. The reaction has been pretty surreal. Just a little taste. Phenomenal. Visual masterpiece. Mind-blowing. There seems to be a lot of confidence in James Cameron, which was largely expected. And for Cameron, too, you know, it's been reported that this film has to land in the top 4 or 5 movies of all time just to break even. So I'm sure he wants to see that enthusiasm. Theaters as well. Ticket sales are down about 30% compared to 2019. So if Avatar 2 can, you know, add to that momentum into 2023, that's a great thing for them. There are some downside risks here. One being the fact 3D. I'm not sure if people really are into 3D as much as they were 13 years ago once the original film debuted. That's also another risk. Are people still connected to these characters? But considering how well the re-release did, I think we're going to have a slam dunk sequel.
I'm surprised they pulled it. I thought they would have kept it in theaters a little longer. It has the top 2 billion, you said? 2 billion?
Yes,
worldwide?
it has the top 4 or 5 grossing movies of all time. So to break even. So that's
in its favor, it's a movie you have to see in the theaters. It's not one that really I mean, it'll be fine at home, but the theatrical experience is what you need to appreciate this film. I cannot wait. Ali Canal, good to see you. Thank you. Sean, I am very, very excited for this. Also excited for what's moving after hours.
I can tell, and it's coming. It's clear across the screen here, Dave. I'm excited. I don't know whether or not I'm actually going to go and see it in theaters, but I'm hopeful.
Of course you won't.
I'm hopeful. Maybe I will. Maybe I will. All right, let's take a look at some of these trending tickers after hours. We have 4 stocks for you. Let's kick it off with GameStop. A move lower here after hours, off just about 0.3%. Not a huge move. Some important numbers to keep in mind. The sales missed expectations. They also reported a wider than expected loss in after hours trading. Net sales declining just over 8% on a year-over-year basis. Software sales off 19% from just a year ago. 3 months, looking at losses of just about 7%. Year to date, we're in the red, off about 40%. But remember, this is a meme stock that was caught up in the meme trading frenzy. Over the past 2 years, you're still looking at gains of over 400%. Let's move on to Rent the Runway, another mover here after hours. And look at that, shares jumping just about 25%. The company raising its full year revenue forecast. That topped the street's expectations. CEO Jennifer Hyman coming out also saying that the company's restructuring plan was, quote, substantially complete. She also did note, though, that it is a tough environment, though, during this current quarter. 3 months, we're still looking at losses of just about 66%. C3 AI, it's an AI software company. That stock on the move after hours. The company beating on both the top and bottom lines, although right now you can see just around the flat line. We were up just about 10% shortly after these results crossed the wires. They also reaffirmed their full year revenue guidance, but fiscal third quarter revenue outlook a bit short. Again, we're seeing the stock not too far from the flat line. Over the past 3 months, it's off just about 18%. And Duckhorn Portfolio, that stock rising just about 2.5% in after hours. Net sales beating the street's expectations, up 4%, nearly 4% on a year-over-year basis. Adjusted EPS of 18 cents. That was also topping what the street was looking for. CEO Alex Ryan, he's going to join us here tomorrow to talk about these results. Over the last 3 months, so Dave, stock off nearly 15%.
Well, thank you. Excellent job. My stock to watch for tomorrow. Lululemon, the athletic apparel retailer, releases its third quarter earnings after the bell. Analysts are estimating Lulu will report earnings of $1.97 a share on revenue of $1.8 billion. The stock down slightly this year, but has shown some strength. Recently, Lulu up about 10% over the last 3 months. Investors will be looking to hear about how the holiday shopping season is shaping up, and maybe, just maybe, we'll get some details about the status of its infamous belt bag, which has seen which has been really tough to snag. I know you're a huge fan of that belt bag, which I thought was called a fanny pack.
I do. It's so convenient. You have everything right there. You don't need that bigger bag anymore.
Not a fanny pack, though.
Not a fanny pack. It's
not
a
a
belt
fanny
bag,
pack.
and you don't wear it around your waist either.
I do not wear it well. Coming up, Google has revealed its most searched term in 2022, and the top spot has nothing to do with the celebrity nor a major event. Stay tuned to find out. Johnny Depp, Will Smith, Amber Heard, the three people you'd least like to appear at your Christmas party? Also the most searched for names in 2022, according to Google's year-end search for 2022. For the most searched for word of the year overall, though, we should technically give you 6 guesses. We will not, but it is Wordle. Purchased by the New York Times earlier this year, this was easily the most searched for word all year long, and the economy was clearly on the mind of the masses. One of the words looked up the most in terms of its meaning was recession. A lot of economic questions were Googled this year, Shauna, including how do I buy bonds? What is a bear market? Why is gas so expensive? How do I get student loan forgiveness? Tells you a lot about the shape of the economy as a whole.
It does, and it's a little bit worrisome. And I also just think that this just speaks, when you take a look at this list, I thought it was very accurate when you take a look at some of the biggest trends and what we have seen play out over the last 12 months. I was a little bit skeptical when I first heard that Jeffrey Dahmer was in one of the most searched for terms, but when you take into account, I guess, how popular that Netflix show was, it makes a lot of sense. Wordle, on the other hand, it's going to be interesting to see how much that's going to take effect, like how much influence that's going to have in 2023, because I would make the argument it started extremely strong out of the gate. I think if you ask people how often they play Wordle today compared to how much they played it during the first 6 months of the year, that number, I would think, has fallen off a cliff.
I would love to find out. No, I've played it once or twice in my life, but I have a daughter and her mom sit on the couch every morning, and it is a ritual. You're right, though, probably fades away like most things. I was going to guess at the most searched for name of the year, but I guess he got a late start on it. SBF. I thought Sam Bankman-Fried, even though it's only been a couple of weeks, when you think about the implosion of FTX, I thought that would dramatically, just in those couple of weeks together, would rise to the top. And I'm guessing has.
It would be interesting if they could break this down month by month. Then you could really dissect everything that's been going on.
One thing I can add that they're looking for is how do I become an aviator, a flight pilot. They think that it was Top Gun.
Interesting. All right, well, we can keep going on this for hours and hours, but we got to leave it there for you. Thanks so much for joining us this afternoon. We'll see you right back here again tomorrow.